last 10 years, what are the lessons we've learned, and where are we right now in the post-financial crisis world?
Well, this is a great time to ask that question because it seems pretty clear to those of us who are expert, who may know nothing, never forget that, that we're going into an era of much lower returns than we've been accustomed to in the past. And how that will play out, nobody knows. I would be in the camp of saying the market is significantly, not grossly, but significantly overvalued.
स्टॉक मार्केट रिलेटेड इंटरव्यू वीडियो पाने के लिए मेरे चैनल को सब्सक्राइब करें और बेल आइकन को दबा दें.
And assuming that's correct, there are only two things that can happen. You can have a long period of very low returns or a great big drop in the market, 30%, 40%, even 50%, and then get back to the good returns of the good old days. That's a hard way to do it. But it seems almost inevitable that returns will be lower somewhat than this 35 years or so that we've had the greatest bull market in recorded history, with the S&P 500 growing at 12% a year, which means, mathematically speaking, simply enough, that if you started with the S&P 500 35, 40 years ago, you now have $60 for every dollar you started with. And so it's not genius, it's the market. And you kind of wonder how the mutual fund industry has held itself together against the onslaught of indexing. And I think the answer to that is in this great bull market, if you had a 10% return, which is roughly what the average fund has given you, you got 40 times your money instead of 60. Well, nobody's looking at the 60, and they're saying any manager that can take my dollar or take my $10,000 and turn it into $40,000 is my friend forever. And he's a genius, and he's actually fallen way short of the market. So one of the lessons is, I think, or one of the messages, perhaps more importantly, is the trees don't grow to the sky. And I'm really quite confident about that. But confidence in this business is a dime a dozen. So I'll just take a moment maybe to talk about my methodology. And this methodology is so good and so popular that it has never been used by anybody but me. But for 25 years, I've been using the same methodology. So it's all what actually happened after prediction. And I divide the market, the market return, into its two sources. One is investment return, one is speculative return. What is investment return? Today's dividend yield plus whatever earnings growth we get in the future. It's averaged about 5%, could get to 6%, 6 or 7%. It can't really be much higher than that. And unless you get a depression, it's not going to be much lower than 2. So there's not a lot of room to differ there. But I'm using right now for the next, the long-term average is about 5% earnings growth. So we take today's 2% dividend yield, and my guesstimate, gives us 6% investment return. The other part of it, which is the more troublesome part, is speculative return. And speculative return relates to valuations, which we can easily measure by changes in the price-earnings multiple. And if PE goes from 10 to 20, that's 7% in a decade. I don't do anything short of a decade. If it goes from 10 to 20, that's 7% of extra return. And we got that in the 80s, and we got it again in the 90s. And we're not going to get it again, because PEs can go from 10 to 20 to 40, but I don't think they can go to 80, which would be required if you follow the math. Sorry to bother you with those numbers. So I think any responsible market predictor should look at these three elements of return, two elements of return, investment and speculation. And so I expect the market return to be 12% or X. I accept, here's what the dividend yield is, we all know that. Here's my estimate for earnings growth. We can't be too far different on that. 3 or 4 percentage points would be a lot. And then here's my belief on the valuation of the market. And so I believe that we will probably go, the PE in the market is about 25 times today. That PE is based on GAAP earnings, accounting earnings, and not operating earnings. Operating earnings are much higher, leaves out all the bad stuff. Always a good idea if you're promoting something. And if it goes to 18 times, say, that 6% that I gave you from investment return take off 2 percentage points for the drop in the valuation, would give you about a 4% return in the stock market over the next decade. Now, we've been doing this in 10-year periods for 25 years. That means we have 15 actual predictions, and they have a correlation of about 0.81 with the actual returns. Some of the errors were fantastic. You couldn't imagine you could be so far off. And actually, my very first estimate was the worst one. And that, as I said, the market return would be about 11% in the decade of the 1990s, beginning 1990. And it turned out to be 18%. But by 2003, the 13-year return was 11% because the market went up, stopped at the high, and went down. So timing is a funny part of it. But I still go with that because it's the reality of life. And the question really today, the big question I think for the marketers, the market itself, or market experts, or investors for that matter, is will there be a reversion to the mean of the price-earnings multiple, or are we in some new lofty territory, a permanently high plateau? Quoting from somebody who said that right before 1929, I think it was Roger
Yeah, I was
Babson.
going to say.
I don't believe in permanently high plateaus.
Yeah, well, so when do we jump off this plateau, and what triggers it?
Well, I would have no idea about when. I just don't know, so not really much point in guessing. I mean, it could be today, and it could be not a big fall at all, but just low returns. But I think the combination is pretty much set up to have returns in the range of 4% for stocks in the next decade. Now I'm a little embarrassed because that's what most people are saying. That's essentially what BlackRock is saying, Larry Fink. It's essentially what Vanguard is saying. And I usually, in my predictions, I don't like company. The crowd, I was always taught the crowd is always wrong. So we will see, but I think it's, for an investor who's thinking ahead, it's wise to be a little conservative. Never, never, never get out of the market. You know, if you want to reduce, you know, I should do this right now. This
Little
is
marketing.
This is a present to you.
Oh, yay! We have to see what
Of my
the
new book,
description says.
and I explore all this in there. But I
Love being
also-
a valued partner. Awesome.
My this is the 10th anniversary edition of my new little book, which I'm not really here to plug. There are 2 booksellers in the back, and just you just give them your club number, everything will be fine. There are no booksellers back there, obviously, but that's where I go through the mathematics that I just described to you, and a whole lot of other things about the fund business. But I fall back when you get to asset allocation, that if you go back to 1949 and read Benjamin Graham's The Intelligent Investor, he said never less than 25% or more than 75% in either of the 2 asset classes, bonds and stock. So you can be 25 stocks and 75 bonds, or 75 stocks and 25 bonds, and stay in that range. And you want to make a few little adjustments, do that, but don't think there's a scientific way to do it. Try and accommodate yourself.
So without talking too much about timing, maybe we can talk about a few things in terms of what you're thinking of about risk in the market right now. I mean, ETFs have been something that a lot of people have been sounding off on, looking for a potential correction there, you know, looking at the way in which all this money pouring into these funds has shifted things. What's your view?
The chapter in my book on ETFs is called A Traitor to the Cause. Traitor, not traitor. Wouldn't dare say that, but it is that too. And I'm bothered about ETFs. They are, think about it this way, that we have passive investment strategies, call it indexing. And there are 2 groups that own them, passive investors and active investors. And the traditional index funds, TIFs I call them, an acronym which has never been picked up by anybody but me in 4 years or 6 years, and ETFs, to give you the bouts. And ETFs are clearly passive funds owned by active investors. Active investing is trading. Active investing is speculation. Active investing is losing. And ETFs are a loser's game. Let me be very clear about that. We were doing some mathematics. Mike Nolan, you want to wave your hand? My good assistant who's here with me. And I should introduce my son Andrew, who's here in the first row, of course. So I was just playing some numbers games. I looked at the growth of exchange-traded funds and traditional index funds in the last decade, roughly. And they were virtually identical. They'd both grown at about 18% a year. And then I looked at the sources of that growth. And the sources of that growth for the traditional index funds, it was 65% appreciation and 35% new capital coming in. And for ETFs, it was exactly the opposite. 35% appreciation and 65% for capital coming in. You kind of know that from the press. They're very popular. They do all kinds of wild things, which I could talk about for a minute later on. But in any event, I thought, well, wait a minute, there's a message here. If the appreciation is heavily concentrated with traditional index fund, what does that mean about the returns of the two? That the returns of ETFs are considerably lower than the returns from traditional index funds. And you can measure this pretty easily. Mike does it for me. I can't tell you it's easy firsthand, but we go over the data. And it turns out that the traditional index funds have had a return during in that period of 7%, 7.1%, and the ETFs have had a return, the average ETF, of 4.7%. That means you had your choice between a 10-year return of roughly 120%, I'm doing a little bit of this off the top of my head, or about 70%, 110%, 120% from the traditional index funds, and a return of about half that, 65%, from exchange-traded funds. Why doesn't anybody know that? Why is that news? And does nobody care? And the reality is that ETFs are probably the greatest financial innovation of the 21st century. They are probably also the worst investment innovation of the 20th century because people use ETFs badly, and the sponsorship is wild. Henry Kaufman would call them, if he were around at this meeting today, he would call them financial buccaneers. And what's the response? Rana, what they do, open up a paper 2 or 3 days ago, we have 2 new ETFs. One is ETFs that are long electronic marketing firms and short retail marketing firms. That's an ETF. They brought it out just to capitalize on this momentary trend that's going on there. Then we have one just brought out for distillers, people that like to drink or whatever. And then we have another brought out for people that believe GOP policies will win. And of course, another one that people believe that Democratic policies, you have your choice.
Risky bet.
It's an insane marketing game in which, do I make myself clear?
Yeah, I think you do. I think you do.
In which salesmen need something to sell. So we throw out more new red meat to be sold. It's a marketing business still, the investment business. It should be much less of a marketing business and much more of a fiduciary business, I think. I know. And it's obvious that trading is your enemy and is the investor's enemy and the broker's friend. I mean, this is not complicated. So I'm really troubled. And you see this in ETFs. The capital flows are wild, up and down, month after month. And sometimes those change in capital flows or the capital flows themselves, maybe 80 or 90%, the SPDR, the Standard & Poor's, they have their phases where everybody likes them or nobody likes them. So you look at a given month and you see let's say a $10 million inflow into ETFs, and it's $9 million in the SPDR. It's a very market-moving thing that they're very proud of at State Street, and they brag in the paper every day. It's the first time in history that any stock has turned over at 15 million shares an hour. They're proud of that. They're proud of that. Think of that. What is that to be proud of?
Well, so this is something you and I have talked about a lot. You've written a lot about speculation, about the divide between Wall Street and Main Street. And I know that you have thoughts on how the role asset managers might play actually in bridging some of that gap. Do you want to talk a little bit about those issues?
Well, first we start off with a simple kind of an equation, if you will. And that is when you take the total return of the market, that's the return that all investors share in gross, and after you take cost out, it's a loser's game. Investors lose to the market. Total market has, however measured, S&P 500, total stock market, it really doesn't make much difference. That total stock market index, the old Wilshire 5000, and take out about 2% a year for the cost of investing. And it may sound a little high, but you have like a 1% expense ratio for a typical mutual fund. A typical mutual fund turns over at about 80% a year. Just think of that. Short-term trading, I mean, that's the business. Average holding period for a stock, I don't know, a year and a half, something like that. And that costs money. And if you say that costs another percent, that's the 2%. And you've eliminated the fees of an investment advisor to pick the fund, another 1%. You've eliminated sales loads, you haven't counted them. That's another 1 or 2 or 3%, however. So 2% is really a decent but moderate estimate. And so if you're in the market for a lifetime and you earn don't hold me to this, I think I just did maybe 50 years, and you earn, let's say, a 7% return, you'll end up with, say, $30 per dollar, something like that, invested. And if you do it and earn 5%, that's the 7% in the market, less the 2% playing the game, you end up with $10. So you've given up 2/3 of your return, $30 versus $10. You've given up $20 of return to the market system. So think about it this way, Rana. You put up 100% of the capital. You took 100% of the risk, and you got 1/3 of the return.
Yeah, not a great deal.
If that seems like a great deal to you, yeah, maybe I'm not making myself clear. So all this depends on a long-term time horizon. Doesn't matter much in a year. All this depends on low cost, which has come totally into its own. And all of this accounts for the burgeoning of indexing. In the last decade or so, about $2 trillion has flowed into index mutual funds, and about $1 trillion has flowed out of actively managed funds. That's a $3 trillion shift in investor preferences on an asset base that probably averaged $6 or $7 trillion, 50%, something like that. So it's a major shift that means that people are finally recognizing the importance of cost as reflected in indexing. And it's going to continue. Indexing has gone from when I started the first index fund, it was obviously 0% until that fund got started. And as a little anecdote, I met with the underwriters. We had the 4 largest retail underwriters for the first index investment trust, now the S&P 500, Vanguard S&P 500, back in 1976. And they thought they could do 250 million. Think we can hit 150 million, okay. 100 million looks sure. I know we can get 50. Think we can do 25, okay. And they hand me the check, $11,300,000. 11 million instead of 250. And one of the underwriters said at one of these kind of catch-up meetings, you all know what they're about. There might be a cocktail involved, and there might be a lot of old anecdotes involved. And one of them said, how is it possible that the worst underwriting in the history of Wall Street could be the most major innovation in finance, probably in a century?
Well, maybe that's a good point to ask about regulation. As I mentioned at the beginning of the meeting, Jay Powell came out today and said, look, we have enough regulation, we don't need any more, maybe we need to loosen it even a little bit. You're already hearing protests about that. Where do you think we are in terms of banking regulation and also mutual fund regulation?
Well, I like regulation as little as anybody else. It can be intrusive, it can be detailed, it can be bureaucratic, it can be unevenly administered, it can be unfair. But most regulations that we have for mutual funds and for banks are regulations that we earned. We did something wrong, and we're paying a price for it. I mean, think of the mutual fund market timing scandals, a moral outrage, and not the only moral outrage. We could go into moral outrage as a separate component of the talk, Rana. Funds went out of business, or almost out of business, that had done that because investors saw they were in the wrong place. On the banking side, I'm not a total banking expert at all, but I think the banking regulations, there are probably rough edges. But the idea of repealing the bill, Sarbanes-Oxley bill, is just plain crazy. It did a lot of very good things for us, continues to do good things for us. And I happened to be the chairman of an audit committee for Instinet at that time, independent director, and I was the chairman of the audit committee. And man, did we go over all the filings you had to do. And the board of directors really depended on me to work directly with the auditors, which I did, not with the management, but with the auditors, to make sure we complied fully with the various provisions of the Act. And they were painful, but they were right, they were correct, they were in the right direction. They brought things to light that had not been to light. So I'm not in favor of any vast overturning of Sarbanes-Oxley at all.
Dodd-Frank.
Or Dodd-Frank, excuse me.
Yeah.
The previous bill.
Yeah,
that was good
it's
enough.
all right. It's hard to keep track.
No, thank you.
But so do you think your judgment then is that Dodd-Frank has taken us to a pretty good place? You think it's a good piece of legislation?
I think on balance, an excellent piece of legislation. Now, there are always little things you can do, and it's hard to administer, I don't know what's going to happen to the so-called Volcker rule. It's a very hard rule to administer. It's aimed in the right direction, but it's very difficult to dictate behavior, to dictate ethics, to dictate morals, to dictate standards. So you try and do it legislatively, and that's never an easy job. It's often unfair, and I think if you can find those areas where it cuts too deeply, gets into the muscle and toward the bone, it can be amended. But then you get to, I don't want to get into politics particularly here, but try and get something done in the Congress, or try and get anything done. I found in my career the most difficult thing in life is to change something that is in place. It doesn't matter how stupid it is, if it's in place, it's hard to change. And you go through the convoluted legislative process, the politics of it all, particularly at this time in our nation's history. And there are no easy answers. I mean, that's, everybody in the room knows that without my telling them.